welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in. And if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to episode 57 of the Capital Mind podcast. In today's episode, we do something different, and Deepak talks about two opportunities in front of us towards the end of November 2022. One obvious and one not so obvious. On the obvious front, we talk about LIC and how Deepak feels that despite, or rather because of the disappointing IPO, followed by recent changes in accounting rules, and generally learning how to better operate as a public company, means that there's a compelling argument for meaningful upside in the stock, something that's even more surprising given the size of the company. On the non-obvious front, we talk about the HDFC and HDFC Bank merger and how rules around index constitution can have some quirky results, and we might see some unintended consequences playing out very soon. So do listen in and see if you agree with either of these, and do note that they're his views and they're not investment advice. Deepak, a lifetime ago, you had recorded this podcast episode talking about how LIC is going to become the biggest company in India and how it's only a matter of time. And when it comes, it'll dwarf everything. I'll find this somewhere. But what I can find easily on Screener or any other website is that LIC has fallen some 30% from its IPO. It looks a bit like a dud. So what's going on here? I mean, this was supposed to be the giant to end all giants. Instead, it's something that's barely in the top 10. Did we just get it very wrong, or is something else going on?
Shray, firstly, I think I got to say this. We own it in the PMS, so heavily biased on this. But, honestly, I also thought, what is going on over here? Because our whole analysis was X and something else happened. And, we were expecting this company, this is LIC, with the current market cap is about 400,000 crores, to generate 8 to 10,000 crores of profit per quarter based on whatever they said in the DRHP and all that stuff. And now we're only getting 1,000 to 2,000 crores odd of profit. And then here's where I think the problem is. This is a company that does not know how to behave like a company, much less a public listed company, simply because they've never been a company. They've always been a corporation where you've been set up for the benefit of policyholders. You largely operate for the policyholders, and all your policies and operations are around this concept called, if we make some profit, we'll share it with the profit policyholders. Something we'll keep for the only person that actually has an interest in this company, which is the government. The government would get like 5% of something. When you became a company, you became like just about any other insurance company. And when you become a company like any other insurance company, you have to respect that the shareholders have rights, and the shareholders are the ones that need to benefit from profits. And therefore, you can't operate like a corporation anymore. Now, the government itself did not really care about profits, but they were propping up stocks. For instance, if ONGC went for an FPO, there were no buyers. LIC would come in and buy it. So there was a kind of a give and take kind of a relationship over there. However, things have changed. This has become a listed company, therefore it has to act like a company. It has shareholders beyond the government, so just think of what it has to do as a shareholder, as a company that respects its shareholders. Plus, management and employees are also incentivized by IPO shares or by ESOPs. I don't know if they're ESOPs, but assuming that they will be, or they might be compensated as a consequence of it, it makes sense to maximize shareholder value. Things have changed, but the attitudes inside of LIC haven't exactly changed that fast. So things have moved a lot slower than we thought. What happened in the IPO was a massive change in the first place. So if you're a corporation, you're different. Now, if you're an operating company, there is a certain set of rights to profit. So certain things that happen in an insurance company are, you have basically LIC had just one big policy fund. But insurance companies, as insurance companies must, they actually separate their funds into two types. One is a participating policy, one is a non-participating policy. Participating policies are typically something like a whole life policy where they say, well, listen, you keep on paying your premiums every year, and we'll take the premium part of it is for insurance. So we'll take that out. Whatever's left, we will invest it. If we make a profit, you will participate in that profit, and we'll maybe give you an 8% bonus every year. So effectively, your money grows at 8% every year. In the end, it makes a big fat kitty. You have the right to all of the profits under that pool, the participating policy pool. Lots of such policies. They can call them money back policies, or most money back policies tend to be participating policies, but some don't, and I'll come to that. But basically, the idea would be you pay. I had a policy like this where you said you paid something of the order of, I think, 2,000 or 3,000 rupees per year. Sorry, 5,000 rupees per year, and every 5 years they would pay back 15,000 rupees. So effectively, I would have paid 10,000 rupees for those. I mean, that's the way I was sold the policy. See, you paid 5,000 rupees for 5 years, then we pay you back 15,000. Then you pay another 5,000 for 5 years, we pay you back another 15,000. At the end, what happens is there's a big profit pool that is declared on this bonus on this entire thing. And instead of getting back just the 1 lakh rupees that you've paid in 20 years, you get back 2 lakh rupees because so it sounds very exciting. But this is a participating policy because the bonuses are based on the profits that the participating pool makes. This is all understood. LIC was 90% plus of these policies. Most other insurance companies have very little of participating policies because that doesn't make sense to give all your profits to policyholders. Instead, they focus on what is called non-participating policies. Now, this is where things changed. Okay, the non-participating policies are a relatively different beast. For instance, if you have term policies, I pay a term policy to an insurance company. I don't die. The company keeps the money. They don't have to pay it back to me. Now, assuming I pay some money for 30 years, and in those 30 years, I don't die at all, the company gets to keep all of that money. So at some point in time, the company gets, the company does not have to return it to anybody. So technically, it is their profit. It's the shareholders' profit in a way. Now, let us say I didn't die for 5 years, but I'm going to pay the policy for another 25 years. They might say, listen, he may have paid premiums for 5 years, but we shouldn't take away all the premium that he's given us because it's possible that he still dies in 25 years. So can we then allocate a certain amount of probability that he will die in 25 years, and that probability is an actuarial calculation and says, oh, well, our liability maybe, for a 5 lakh or 10 lakh rupee policy, it may be something of the order of, say, 50,000 rupees, and say, we'll keep 50,000 rupees aside. It's much lesser than that, but keep 50,000 aside as a potential that he will die in the next 25 years. And the next year, it could be 60,000, it could be 40,000, it could be different based on anything like that. So you keep a certain, whether you call it a solvency margin or an actuarial kind of a provision, you keep that aside, and anything above that is still a profit that goes to shareholders. Right. So this is how non-participating policies work. Term works in that way. So there is another kind of policy called a pension policy. A pension policy is you pay into the pension policy all your life. You will actually then eventually get a pension for the rest of your life. Now, if there's a guaranteed pension, so if you pay out X amount, you will get a guaranteed Y amount. So you pay 10,000 rupees per month in the beginning, and then they'll pay you, say, 15,000 rupees a month for the rest of your life. So if you pay for 40 years, they then do an actual calculation saying, listen, we expect this guy to live till about, say, 85. On average, India lives till 85. So if I have enough people, they should meet the average. If the average is being met, then I have to, on average, pay for 25 years. Some people will die before they're 85. Some people will live till they're 95 or 100. And balanced out, my average will still be 85. So I know that I have to keep 25 years of how much ever I have to pay in abeyance. If I have investments that have yielded so much that not only can I pay for the next 25 years, but I will actually have a surplus beyond that as well. Anything beyond that is a profit. That profit belongs to nobody. It does not belong to the participating policyholders because this is a non-participating policy. So it belongs to shareholders. Effectively, this is a surplus. Like this, there are other types of insurance policies which are non-participating. For one, the kind of policies you'll be sold. Recently, they're going around selling these policies a lot. You pay me 1 lakh rupees for 5 years per year. In the 7th year onwards, I'll pay you back, 75,000 rupees per year for 25 years. And after 25 years, I'll pay you back the entire 5 lakh rupees that you paid in the first. Now, you might look at this and say, well, it's exciting. I'm getting all my money back in. But if you calculate the yield on this, it might come up to be something like 6%. Now, 6% is a relatively easy yield to achieve if you do something like a 20-25% equity and 75% government bond, because government bonds today are yielding 7.5. In fact, at the lowest that they've ever yielded, they probably still yielded of the order of 5.5 to 6. So you're getting this 6% in good and bad times, and over time, you're going to make this profit no matter what happens. Once they finish their 5 years of paying, you can lock in the yields for the next 25 years. If you lock in a yield of 7% and you have to pay out only 6%, that extra 1% per year is your profit. So if they've given, if this policy is 1 lakh rupees, then 1,000 rupees per year for such a policy is a profit. So the excess yields are typically of the order of 1 to 2%, maybe 2%. So this is where our calculations came in. And hey, wait, what were you guys taking out earlier was only 5% of this profit pool. But you told us in the IPO that from January 1st, 2022 onwards, you're going to have a non-participating pool. In that non-participating pool, you can take out 100% of the surplus as a profit to the shareholders. This is fantastic because 100% of this profit sounds like a huge deal. Now, why is this such a huge deal? Because if you have, then they have roughly 10 to 11 lakh crores under non-participating as AUM in total. If they earn an excess yield of about 2%, I'm just giving you an example, that's about 20,000 crores per year that you're getting as excess profits. That means 5,000 crores a quarter at least. And we estimated this to be even higher than that because their participating policies also has a profit generation part of the business. And there's a bunch of others, including surrender, all that stuff that comes in. That adds up because most of the costs sit inside the policyholder's account, including salaries and so on. Most of whatever comes to the shareholders is almost plain profit. And remember this, LIC pays no tax. Insurance companies in India don't pay tax. So you end up with this situation where you have a tax-free return of 20,000 crores a year. That's what we thought. At least 20 to 30,000 crores a year should be a tax-free return to shareholders. So this company should be worth, because it has no debt, it has no liability, because any losses that happen occurred mostly to policyholders, are very little to shareholders, in general. You're actually sitting here saying what this company should be revealing as much as, 5,000, 7,000, 8,000 crores of profit per quarter. So for that, you should be valuing this company at a tremendous amount, 20 times earnings or 30 times. Because remember, public sector insurers are valued at, private sector insurers are valued at 80 times earnings. Relatively younger companies which don't have the maturity. So let's assume, okay, you give a government premium, you give a lower premium for the maturity of LIC and so on. But even if you consider the other factor, which is something called an embedded value, the embedded value component is about how much it's effectively an insurance calculation of how much. It's a calculation that tells you how much you might want to value the company at, and there's a mix of new business premium and which are non-par versus non-par and so on. This EV, HDFC Life gets nearly 4 times EV. That means if their EV is 15,000 crores, they're getting valued at 60,000 crores. That's the LIC's EV is 5,40,000 crores. Their market cap is 4 lakh crores. That means they're getting 0.7 or 0.8 times, 0.7 times EV. HDFC Life is 3 or 4 times EV. And most Chinese insurers also are at least 1 to 1.1 times EV. For India's largest insurance company, which is actually growing. In fact, its market share has increased in September 2022 compared to September 2021. So it's not like it's stagnating. It's actually aggressively increasing its market share. For that company, which was earlier giving only 1,300 crores of profit, we thought this was, we had made the complete wrong decision over here. What is going on? And then this quarter, in fact, 5 days ago, we somehow got vindicated because they said, oh, you know what? We have 15,000 crores of profits that have been sitting in this non-par account, which we didn't know we could take. Because remember, they haven't operated as a company, so they don't know how all this. I mean, maybe they knew, but they were too scared to. I mean, 15,000 crores sounds like a lot of money. So they went to IRDA and said, "Can we take this out?" IRDA probably is like, "Dude, everybody else is doing it. Just do it already." But they would have said better language. But the idea is that they got this approval from IRDA to take it out, which was more like IRDA must have been like, this is the rule, you can do it. You knew you could do it. This is not DRHP. But they said, okay, we'll take it out. And they took out 3 quarters in one go. So they got 15,000 crores of profit in one go in the September quarter. So that means January to March, and it's actually been increasing. January to March was less, 4,000 something crores. The September quarter is actually 5,000 plus crores. So it's actually been increasing. And that's because the share of this non-participating business is also increasing within LIC itself. All this comes out in one quarter. It becomes a 15,000 crore quarter for this company suddenly, right? So it's recognized, all of it is in one quarter. Of course, the market reacts nicely, gives it a 6% bump. So the profit, the market cap goes up from 350,000 crores to 400,000 crores, roughly, or maybe 370,000 crores to 400,000 crores. But effectively, it isn't still making sense because, and I went through the conference call. I wasn't believing that this is true. I was like, is this a one-off? But if this is a one-off, they'd put it in some kind of an exceptional item or a one-time item. They didn't do it. They put it as a regular transfer. So I went through the conference call, and right towards the end, it took an individual investor. Now, the analyst asked this question. The individual investor actually said, listen, what is this thing that you're doing, and are you done with it? Is it over? So the LIC person actually says, no, what is done with it? We're done with only the last 3 quarters. From now on, we will just keep recognizing this income every quarter as it comes. So the light bulb in me starts to go off and said, okay, this is true. That means they're going to transfer of the order of 4,000 to 5,000 crores per quarter to the shareholders account every single quarter. I mean, this company, which is a market cap of 400,000 crores, is probably going to get 20 to 30,000 crores of profit per year, because they are finally recognizing that they could take the profit that was theirs away from the policyholders onto the shareholders account, because it did not belong to policyholders, it belonged to shareholders. This is quite an interesting point, because your LIC is actually heavily into participating policies. It's about 90% participating policies, 91% in fact. But they're saying, listen, we're introducing new policies. All of them are non-participating. We're educating our staff, because they earlier would get more commissions on participating policies. Now creating a structure which allows non-participating policies to be created. This entire structure gives more credence to the fact that LIC is actually moving towards a 20 to 25% non-participating policy mix. If 20 to 25% of it becomes non-participating, that means this payout of 20,000 crores per year that's currently coming will probably increase to 40 or 50,000 crores, which is huge from that perspective, which is effectively you're paying for a company whose embedded value is 5,30,000 crores, whose net profit per year will end up being of the order of 40 to 50,000 crores. You're paying as much as 0.7x or just less than 10 times earnings. It sounds like an opportunity that's just too good to be true, but this is insane, because I think it sounds like it's bafflingly undervalued.
So I have some reactions to that. So my first one is, look, could one of the reasons be that while we understand that there's this profit, and in a steady state, maybe it's like, 5,000 crores a quarter. If stock markets, say, don't do particularly well over the next decade, is this 2% spread that you're thinking they'll earn? Maybe that won't be there anymore. Maybe it'll just be loss. And so it's unpredictable in that sense. That's one. And the second fear I have is the government may not have much in terms of wanting to take out in the form of, say, money from the company. But what if it directs LIC to invest and bail out some companies? Isn't that another way that earnings could be impaired? And finally, look, I do have a question. Look, this is not some tiny small cap, right? I mean, this is one of the largest companies in India. So why do most people not agree with you? What are your thoughts? All three of these.
Yeah, let me go with the first one. I think the first one was around
If stock markets fall. for
yes.
the next-
So if there is a stock market fall, or one of the things that so let's say that you look at this from the point of investments of the participating policy holders, that is not really something that we should worry about because shareholders are not responsible for it. If it's part of, let us say, the amount in non-participating policy holders, now typically they don't do more than 10 or 20%, maybe 10-15% in stocks, and they have stocks from a very, very long time back. Apart from that, they don't just mark to market all the stocks that they have. I mean, they will do mark to market to a certain extent, but they will actually put an actuarial provision that says, listen, we do want to understand that the markets will fall 10 to 20%. So let's take 20 to 20% as a fall, a haircut on the markets, on the valuations of whatever we own, so that even if the markets were to fall 20%, we would still actually, be okay. So that buffer for stocks is a given. A buffer for bonds is given. Even government bonds, they take a small, because prices of government bonds can also go up and down. So you give a certain buffer for government bonds as well. What this does in the books of LIC is that it creates provisions in the non-par book. I am talking of right now they have that as well. And they will continue to have that. But the excess beyond that is 4,000 crores. So, and if on average over a 5-year period, stock markets can go up and down, but over a 5-year period, they tend to go up. And India has positive inflation, so it almost always goes up like that. So if stocks go up and bonds also go up, because government bonds don't default, right? So even if you have a provision in place, over time, that provision, the fluctuations in price will come back down. So it's not like the government bonds will default. So as it gets closer and closer to maturity, every government bond goes back to the 100 face value that it is at. So effectively, your provisions will shrink over time because both stock markets will recover. And remember, stock markets only 10-20% of their So in a way, that risk is already taken care of by high provisioning in the non-par book. It's beyond that in the non-par book that is where the money is coming out of the non-par book, because they have very high solvency margin ratios. I think 1.88 or something, which is relatively high for that in that sense. And even if the markets were to crash 50%, I would wager that they don't have a problem in terms of paying out. So one is that, of course, some part is not their liability. Whatever is their liability is covered by a provisioning margin. That is fairly sufficient. And all these profits that are being taken right now are beyond whatever those provisions are, which are conservative provisions. The second part of the question is, what happens if the government is being used to bail out companies? Now, who takes the hit? For the most part, it is going to be the participating policies, because they are about 75-80% of the overall universe of whatever the LIC owns, and LIC therefore is not going to see the brunt of any fallout of such events. More importantly, I also think that whenever the government does ask to bail out, there's also this hidden clause in there mostly that may not be necessarily something that's hidden, that's told to you directly. But I think there is going to be some kind of a clause in there that says, well, at some level, if LIC is in trouble, we will come and rescue it. So that's almost like a hidden, because that's the reason why LIC sells so much, is that the government is backing it. Lastly, I think there is also a lot of more money that's coming in. So, it's in a way, it's like the reason LIC would be in trouble is if it was not getting any more money coming in, and then but if you look at, the RBI releases a list of household assets that are, household savings that are moved to financial assets, which in its last term, it actually says, okay, for every incremental rupee that was saved, where was it saved? So 50% of that rupee saved goes to fixed deposits. So if 100 rupees was saved by all of the households in India, 50 rupees has gone to fixed deposits. 0 point something percent goes to equity. 6% goes to mutual funds. 12% goes to insurance. So effectively, insurance commands 12% flows, double the flows of what's going into mutual funds every quarter. And of this space, there's a 70% stranglehold by LIC, in the sense they own 70. So effectively, LIC alone probably gets more inflows than all mutual funds put together. this is a growing company. This is a growing country. Savings continue to grow. In absolute terms, may not be in percentage of GDP, but in just absolute terms, they continue to grow. So there continues to be a greater flow into LIC. Again, that increases solvency because you have more and more capital that is available and new that's coming in that does not require you to sell your assets to pay for some old liability. So you can continue those. So if somebody dies, most likely from just new premium that's coming in, you can pay out for the people who've died instead of having to sell, say, shares of Reliance or whatever else that they own, because the new money just pays for the old, and then you just do the accounting switch into the new money gets the old wala valuation and all that. It's just a accounting switch. But what's interesting about this is, since the flows are huge, you have a fairly strong business in this, in this space. Then you said, it's not a tiny cap. What about if there's $1 on the road? How can there be $1 on the road? Somebody should have picked it up. But we found a lot of such dollars on the road. And one of the biggest examples of this was IRCTC. And IRCTC was one of those companies when they came out with an IPO, the government actually changed the rules. And again, look at LIC. They changed the rules just before. They changed the rules as in LIC's rules changed just before they went IPO. IRCTC rule change was simple. In demonetization, the government had said IRCTC cannot charge 20 rupees per ticket as a booking fee because they wanted to allow for more digital sales versus people standing in a queue because there was demonetization, there was no cash. In 2019, when IRCTC listed, the government switched its position and said, listen, it doesn't make sense to not charge this 20 rupees anymore, 15 or 20 rupees or whichever it was. Now, given the fact that 30 crore tickets were booked on IRCTC every year, and this is because it's the only place to book for railways, you're almost guaranteed to get it. You're going to charge 15 to 20 rupees. You're going to make a straight below the line profit. It's a bottom line profit straight because it was profitable even before this exercise. That 450 to 600 crores extra would flow into IRCTC. And this is a 4,000 crore company. So effectively, you're creating a company whose net PE ratio was less than 10. And this is after the stock has listed at 3x the IPO prices when So I discover it only after it has gone up 3x. Saying that, listen, it's 3x the IPO price, but yet it's valued at 4,500 crores, which sounds like a ridiculously undervalued number. So we still went in and bought. Again, this was the same of, how come everybody hasn't seen this before? We validated it with a few people. Some people looked at me and said, Deepak, you're seeing this now. I saw this in the IPO. I'm like, okay, that's fine. But why aren't people buying now? I mean, it's been, but then, well, I don't know. There's a dollar bill on the road. Are you going to say there's no dollar bill on the road when there is a dollar bill on the road? So either you stop trusting your eyes, which doesn't make any sense, or you say there's a dollar bill on the road. Nobody has yet picked it up. I'm going to go pick it up. So maybe one of the things that's happening in this entire episode, and I don't generally get bullish, but this is one of those times when, Warren Buffett keeps saying this, invest when you've got your ducks in a barrel. That's like shooting ducks in a barrel because you're shooting
fish
ducks.
in the barrel.
Fish in a barrel. No, ducks or fish.
Ducks in a row, fish in the
Ducks in a row, fish in a barrel. I'm getting all my analogies wrong or whatever. But the idea is that it should be so obvious that you're almost like, why isn't everybody taking this trade? And this is when sometimes the light bulb hits you and then you're like, oof. I don't want to say this because, it's almost like, why am I telling this to people? But I think at some point it sounds like, okay, if I'm doing something wrong, somebody come back and tell me that I'm doing something wrong, because that's how I want to discover that I am. But more importantly, the fact that the management of LIC has actually said this in a conference call and actually said that, listen, this is going to happen every quarter from now onwards. I'm almost like, why aren't they shouting it off the rooftops? But they're not the kind. They don't have the DNA of this public listed company where, people on Twitter come and say,
VC backed companies.
VC backed companies, which as we have found out is,
or crypto companies.
Or crypto companies who, maybe, but it's fascinating because if you switched from the corporation, which is more a socialistic kind of mindset, to a company which is a more capitalistic kind of mindset, your views and thought processes change. And you can literally see this change happening inside of LIC, but it seems to be slow and almost like, oh, we can do this. Oh, we can earn this much profit. this almost sounds illegal. How can we earn so much profit? But you are an inherently profitable enterprise. You don't pay tax. You don't have any liabilities. You don't have debt. Your entire liabilities are provisioned for before the profit hits your books. And you have a growing market share and a growing India, which is more than happy to continue to invest in you. And yet you're valued at, I don't know, levels which even public sector banks don't seem to be valued at. So it seems to be a dichotomy. I don't want to say invest, but I'm just saying it's an opportunity.
No, I think thanks for putting that out there. I mean, in that sense, and putting yourself out there in this way. So, right or wrong, I guess we'll find out. But as you said, it's glaringly obvious, and so we'll find out how this plays out. Well, thanks for that. Let's now move to our next one, the very non-obvious and painfully technical one. So this is around HDFC and HDFC Bank and index constitution and days between recognition of NSE versus MSCI. So apparently there's an opportunity here, but it's going to take some wading through. So tell us, what is the gossip or opportunity here?
Yeah, though this is a very strange thing, Shray. I don't even know whether I can explain it in the right way, but there's an index called the MSCI India Index, and this is a company called MSCI that creates a index that foreigners use to invest in India, and a lot of them apparently do, maybe about $8 to $10 billion or $20 billion. I don't know, some very large number that's following the MSCI India Index per se. There's a bunch of other indexes as well, including emerging markets and so on. So the way they work is that HDFC and HDFC Bank are merging. The merger ratio is 25 shares of HDFC will give you 42 shares of HDFC Bank. That's the fixed merger ratio. Sounds like a good thing. But what happens if in the MSCI index is that there is an HDFC in the MSCI index, India index, but not an HDFC Bank. That's because MSCI looks carefully at how much is available for FIIs to invest. When they say that, I mean that they look at HDFC and say, listen, how much do you allow foreign investors to invest? Oh, you have 61% HDFC, they have about 66% foreign ownership.
And this is because MSCI is oriented towards global investors, right? Unlike
largely,
yeah, okay.
Yes. So since MSCI India index is actually followed globally, India follows its own NSE and all that stuff. So NSE also, of course, has a Nifty index which has HDFC and HDFC Bank. Of course. But HDFC Bank does not occur in the MSCI index because by nature, a bank can only have 74% FII investment, of which 71% was already taken. So there was only 3% headroom, and they call it FII room, foreign room. This foreign room was limited to only 3%. So since there's only 3% and out of a 74% possibility, the ratio of 3 to 74 is less than 5%. And if you're less than 25%, they don't even want to get you in. So they need a 25% foreign room to just be able to get in. Once you're in, you can be less. And we'll come to that. So the rule also was that, listen, if HDFC is in because it has 30 odd percent or 25% or I think 30 odd percent room for FIS, but HDFC Bank is not in because there's only 3% room for FIS. And for a long time, Kotak would come in and out because sometimes it would have enough room, sometimes it would not have enough room. So it was just messy in that sense. Now what's happened is that HDFC and HDFC Bank are merging. Now NSE has figured out that, okay, this is going to be a big problem because if HDFC is merging with HDFC Bank, then I might need to take HDFC Bank out a few months earlier because of their earlier rules. They said, we will take out a company when certain approvals are done. And those approvals once done, I will take out the HDFC and then I will only keep HDFC Bank. But the merger hasn't yet actually happened because the record date of the merger is on a later date. NSE has figured out this is a problem. And what they've said is, can we then no longer take these shareholder approval or whatever these approval dates are? Instead of that, use the actual merger record date to effect the switch in weights, because HDFC plus HDFC Bank would be 13% of the Nifty, but HDFC alone is, I think, 8%, and HDFC Bank alone is 8%, and HDFC is about, I think, 5%. So together they'll form 13%, and it's a complex kind of calculation in the NSE. But they have said, let's relegate it to the record date, to the actual merger date, and then what this does is allows the index, somebody who's following the index, to not have to do anything. On the day of the switch, they will lose the listing of the HDFC shares, but they will get new HDFC Bank shares and then they will be able to continue to trade. That's all fantastic. MSCI, though, has a different set of rules because they have all these rules around what happens in mergers and all that. When a company merges with another company, they check whether both companies are part of the index. If one is not part of the index and that's the company that's getting merged into, then they say, well, their earlier rule was, well, does that company qualify to be part of the index in the first place? If not, then we're going to take out the first one. The answer to that was complicated because in this case, before the merger, HDFC Bank would not qualify to be part of MSCI index and they had to just take out HDFC, which would have created a big mess. So what happened in that case was HDFC was merging into HDFC Bank and it was likely that HDFC and HDFC Bank together would still not be part of the MSCI indexes, which was a big problem because there would be a flow out of money from HDFC also and therefore effectively HDFC Bank. MSCI in November changed the rules. They said, well, if you merge with a company that's not an index constituent, it's not already in the index, then I'm going to assume it's in the index and then apply the rules alongside. Now, if you're in the index and your FII room is less than 25%, you're still okay. This is where it becomes very interesting because of the complexity that happened when the mergers happened. People figured out this index thing is a big problem. If foreign investors who had 75% of in HDFC Bank brought it down to 65%. Now, HDFC Bank is strange because it is actually owned by HDFC, which has about 24%, 25% odd of the company. And the remaining is owned by other investors, most of whom are FIs, most of whom are foreign investors, including the ADR that is listed in the US. About, I think, 1 crore shares or 10 crore shares are there. So, interestingly, in all of this, out of the 24 or 25% that is owned by HDFC in HDFC Bank, 20% is actually a foreign stake. It's classified as a foreign stake because it's held as a company called HDFC Investments, which is classified as a foreign company. So effectively out of this 71% that was held by foreigners, 20% was the promoter himself. What happens when you merge HDFC to HDFC Bank is HDFC's stake gets completely annulled. Therefore, that 20% foreign ownership piece has gone up. More room has been created. Second, FIs have also sold from 71 to 65. So, there's another set of room that's created. So, when you merge these two entities, actually, the resulting HDFC Bank will have only 61% FII ownership with a 74% availability, which means you have a room of 13%. So that means 13 out of 74. 13 by 74 is 18. So that's effectively 18% foreign room. 18% foreign room allows a certain interesting thing to happen. Now, what is a certain interesting thing? HDFC's market cap is probably less than half of HDFC Bank's market cap. If we were to have both replace an HDFC with an HDFC Bank, then effectively the weight of HDFC Bank in this new index would be double. But because the foreign room is less than 25% but greater than 15%, it's that range, they divide the market cap by 2. So it's a 0.5 multiplier, is what they call it. But effectively, they divide the market cap by 2. So the 5.7% weight of HDFC in the current MSCI index will get replaced by 6 point something percent of HDFC Bank in the same MSCI index. This may not cause a tremendous amount of difference between the two. But what's interesting in this is the timing. Unlike NSE, which waits till the merger date, MSCI does something very strange for foreign companies. That's foreign when they say non-US companies. They say, listen, when a shareholder approval is gotten, that means I don't give a shit about all the other approvals that you guys want. Once your shareholders approve, I'm going to do the switch. That shareholder vote happens on November 25th. This is about a few days from now, and we're recording this podcast on November 15th. So it's 10 days from now. On the date of November 25th, there will be a shareholder vote. There will probably be an okay because everybody wants this thing to happen. And then will MSCI then do the switch? Which means you will sell 5% of what, $10-15 billion or what, $10 billion, which is 5 billion. I mean, that's a lot of money. That's about, maybe 20,000-30,000 crores. I don't know how much that is. But will you switch out that much in HDFC and buy that much of HDFC Bank as an index provider? If you're following an index, you have no choice. You have to do this. So that much selling pressure on one stock. And remember, these stocks trade like 1,500 crores a day. If you bring in a 15,000, 20,000, 30,000 crore volume on one single day, how do you kind of manage it? Is a good question. But if you did that, would you not depress the price of HDFC in comparison and increase the price of HDFC Bank in comparison? This actually reflects right now. So for instance, if 25 shares of HDFC should give you 42 shares of HDFC Bank. If I bought a share of HDFC today and multiplied it by 25 by 42, I think. Yeah, if I multiplied by 25 by 42, I would actually should get the price of HDFC Bank. There should be no arbitrage between the two. But there is. If you bought today, HDFC Bank trades at 1,632 rupees, 1,632. But an equivalent share of HDFC, which is 2,697 into 25 by 42, comes out to be 1,602. So effectively, there's a 30 rupee spread between buying HDFC Bank as a merged entity through HDFC or buying HDFC Bank directly. This 2% spread is probably because of something like this, and it's probably going to widen in the next 10 days because there's uncertainty on what MSCI is going to do. And the two opportunities that I can see here clearly is one, that this spread will widen. So you might want to, until the date of shareholder approval, actually short HDFC, go long HDFC Bank. The pair trade might actually function. But as soon as it widens beyond a certain point, take the reverse trade, because once this merger thing is over, there'll be 1 day of insane volatility, but then they will come back down together. And they should come back down to as close as 1% or less than 1%. So once the uncertainty is over, the spread will collapse. So there are two opportunities here that you could do, and it's technical.
I mean, I was going to be a bit more brutal than that. It sounds a bit ridiculous that you could potentially have MSCI getting rid of one name and adding another and so on and causing all this selling pressure when the outcome is already known or will be known at that point. And why? Look, we've talked in the past about how index funds and all are slowly taking over the planet. And this sounds very worrying if this is what the index funds then do.
Shray, think about it. We're discussing an opportunity because it's the strangest way to do investing. You no longer care about whether HDFC Bank has NPAs or whether it's getting more deposits or anything like that. You don't care. All you care about is whether the index is getting flows from passive funds who have to buy. So earlier, prices of a company were determined by a bunch of asset managers and individuals who would say, I like this bank, I don't like this bank. They would buy and sell, and they would stand to profit and lose from their decisions, and therefore they would be incentivized to make the right kind of decision. Now, you've moved that decision over to a bunch of people who manage an index, who have no reason. They're much smaller people. There are, for 1,000 asset managers and individuals, they're probably one person in an index management team. And a much smaller set of individuals determine the future of whether this company gets money from investors or not, regardless of what its fundamentals are, because of a set of quantified rules that they didn't care to think about in terms of consequences when of such crazy zany events in the first place, and where the rules keep changing, and because the rules change, people get excited and drive the price up 6% one day and down 5% the next day. So it is ridiculous that indexes have become so big that we have given them so much power, and especially those little set of index managers, so much power that they're creating that we have created the exact wrong incentives. And you know what? We saw this in the subprime crisis. We saw this where banks relinquished their own judgment opportunities and said, listen, the credit rating agencies gave this a AAA, so it must be great. Regulators said, oh, it's a AAA, you can put less margin, less regulatory margin against this. Everybody loved that, except once you discovered that the rating agencies were full of, and we have a podcast on that as well, I think they're full of, the wrong kind of stuff. But since you can't trust them and since you shouldn't trust them, every bank is now required to make a judgment call on top of what the rating agency says. And listen, we don't give a damn if the rating agency says something. You've got to have your own team that goes and analyzes this thing and comes out with a view that is independent of whatever the rating agencies say, that performs your view on the stock. You've moved the risk decision making to a person who's actually taking the risk. Why aren't we doing the same thing because active fund management in a way is that, right? Because people who are taking the risk are the ones making the decisions. Maybe it's time that, rules are flattened down and brought into a normal plane of things, and that such crazy zany opportunities should not have ever existed. And we shouldn't have to be talking about these opportunities in the first place, because the index manufacturers can tinker, and they can tinker with things however they want. It's about the people following them and the fact that investors are investing in them because we've made this big deal about, index funds are better. And we've said that as well. But maybe there has to be some more, and we're watching this in crypto. The lack of regulation creates, stud boys everywhere, and who go and play havoc with when the rules are ill-defined. Why should we allow index manufacturers to do the same thing? Shouldn't it be a much more discussed regulated space rather than index manufacturers creating their own set of rules?
That makes sense. Given just the impact they have on flows and on how therefore people behave, there should be less discretion and less opportunity for such potentially baffling situations. So it's going to be an interesting few weeks, at least on your HDFC Bank. Non-obvious trade, we'll know sooner rather than later whether that's right. LIC, of course, it'll be a little bit longer term. But either way, thanks for all the food for thought, and we will see how these all play out over the next year.
Yeah, I hope nothing happens on the HDFC and HDFC Bank thing, and great things happen on the LIC thing, because we own it. But I think, I think much as these things happen on a regular basis, we've never had a podcast that actually discusses opportunities, more like talking more macro and the situation in India and so on. I think this is also where, I don't want to call this giving tips and stuff like that. But I think the idea that an opportunity can be analyzed and brought to light in different ways without having to look at it as, it's a short-term money-making opportunity and therefore something good can happen, something bad can happen. It just gives you food for thought. I love this. It's a nice little new way to kind of take the podcast in as well.
I also hope you're right on the first and the second doesn't come true. All right. Thanks, everyone.
Cheers. Thanks so much.
Thanks so much for listening. If you like how Deepak and the Capital Mind team analyze markets and think about investing, visit capitalmindwealth.com to learn more about our portfolio management service, where we can manage your money with products starting at 0.25% per year and no performance fee. That's capitalmindwealth.com. If you have any feedback, suggestions, or topics for our next episode, please send over an email to podcast@capitalmind.in.